You're sitting at your kitchen table on a Sunday afternoon, looking at your paycheck stub for the 10,000th time. You make $150,000 a year, solid income. You should feel secure. But somehow, after taxes, after deductions, after everything the government takes before the money even touches your account, it never feels like $150,000. And you've probably wondered, if I had $150,000 coming in during retirement from investments, from savings, from the portfolio I've been building, would it feel the same? My name is Zick, and I need to tell you something that completely changes how you think about retirement planning, tax strategy, and what your money is actually worth. $150,000 earned through a paycheck and $150,000 received in retirement are not the same thing, not even close. The difference isn't just a few percentage points, it's the difference between barely getting by and living with genuine breathing room. And almost nobody explains this until it's too late to restructure your entire financial strategy around it. There's a specific threshold, a point where the source of your income completely transforms what you actually keep, and understanding that threshold changes everything about how you build wealth in your working years. Here's what most people assume. $150,000 is $150,000. Whether you're earning it from your employer or drawing it from retirement accounts or generating it from investments, it's the same amount of money. And that assumption costs people hundreds of thousands of dollars, sometimes millions over their lifetime, because the tax code treats earned income and retirement income completely differently, radically differently, in ways that make the same nominal number feel like you're living in two entirely different financial realities. When you're working and earning $150,000 through a W-2 job, the government treats that money aggressively. Federal income tax, state income tax, Social Security, Medicare, maybe local taxes depending on where you live, they take their cut before you see a dollar. But when you're retired and that same $150,000 is coming from a strategic mix of Social Security, Roth withdrawals, long-term capital gains, and qualified dividends, the tax treatment is completely different, dramatically lighter. Think of it like water flowing through two different channels. Same amount of water at the source, but one channel has rocks, debris, tight bends that slow everything down and reduce what reaches the end. The other channel is smooth, wide, engineered to let almost everything flow through. That's the difference between employment income and properly structured retirement income. Same starting number, wildly different amounts that reach your life. Let me show you what $150,000 in employment income actually looks like. You're 48. You're making $150,000 as a senior manager or skilled professional. On paper, that sounds strong, comfortable. But here's what actually happens to that money. Federal income tax at your marginal rate, let's say you're married filing jointly, you're paying roughly $22,000. State income tax varies. But if you're in a state like California or New York, add another $8,500. Social Security tax maxes out, so that's $9,932. Medicare tax is 1.45%, another $2,175. We're at $42,607 in taxes, before you've paid for housing, food, insurance, or seen a single dollar hit your bank account for actual living. Your take home from $150,000, about $107,393. You just lost 28% of your income to taxes alone. And here's what that does psychologically. You start to resent the system. You feel like you're working harder than ever and never getting ahead. You're in this weird middle zone where you make too much to get assistance, but not enough to feel wealthy. Every raise gets taxed so heavily that the additional effort barely moves the needle. You're running faster just to stay in place. Your decisions become defensive. You can't take the career risk you've been considering because you need a steady paycheck to cover the tax burden. You can't negotiate from strength because you need this level of income just to maintain your lifestyle. You're not free. You're optimizing to feed the tax machine while trying to have something left over for your actual life. But watch what happens when that same $150,000 comes from retirement income properly structured. The entire psychological experience inverts. Because the tax burden drops so dramatically that the money actually works for you instead of vanishing before you can use it, let's get specific with a realistic retirement scenario. You're 67, you've stopped working, you've built a portfolio over decades. You need $150,000 to maintain your lifestyle, the same lifestyle you had while working, but now your income is coming from different sources, each taxed differently. Social Security, $45,000 annually for a married couple, only 85% of that is taxable at most, often less. Let's say $30,000 is taxable income. Long-term capital gains and qualified dividends from your taxable investment account, $60,000. These are taxed at preferential rates, 0%, 15%, or 20%, depending on total income. For most retirees, much of this falls into the 0% or 15% bracket. Roth IRA withdrawals, $45,000, completely tax-free. You paid the tax years ago when you contributed or converted. Now it's yours, clean. Total income, $150,000, same number. But the tax picture is completely different. Your taxable income isn't even $150,000 because $45,000 of it, the Roth withdrawals, doesn't count. You're at $105,000 in taxable income, and a significant portion of that is taxed at lower capital gains rates, not ordinary income rates. Your actual federal tax bill, maybe $8,000. State tax in a moderate state, another $3,000. You're not paying Social Security or Medicare taxes anymore because you're not working. Total taxes, around $11,000. You keep $139,000 of your $150,000. Compare that to the working version, where you kept $107,393. You just gained $31,607 in annual spending power from the exact same gross income. That's not a rounding error. That's a different quality of life entirely. Here's what happens when you actually understand this difference. You stop optimizing your working years for maximum salary and start optimizing for maximum retirement tax efficiency. Most people spend their entire career chasing higher income, bigger title, bigger paycheck, bigger tax bill. They defer all their retirement contributions to traditional 401ks to get the tax deduction now. It makes sense at the moment. Why pay tax on that $19,000 contribution when you can deduct it and lower your current tax bill? But what they're actually doing is building a massive deferred tax liability. They're stuffing money into traditional retirement accounts that will all be taxed as ordinary income when they withdraw it. They're creating a situation where their retirement income gets taxed just as heavily as their working income was. When you understand the tax difference, you start making completely different structural decisions. You max out Roth contributions even though you don't get the deduction. You do Roth conversions in lower income years. You hold investments in taxable accounts for long-term capital gains treatment instead of hiding everything in tax-deferred accounts. You're building a retirement income stream that's engineered to be tax efficient. Not by accident, by design. And the person who does this, who sacrifices some tax savings today to create tax efficiency tomorrow, ends up with dramatically more spending power in retirement despite having the same gross numbers. They didn't earn more. They structured better. Let me show you how the same financial events feel completely different depending on your tax situation. You need to generate an extra $20,000 for a major home repair. Person A, still working, earning W-2 income, has to earn about $27,400 in additional pre-tax income to net $20,000 after taxes. That means extra projects, overtime, maybe a side gig. The effort required is substantial. Person B, retired with tax-efficient income, can take $20,000 from their Roth account tax-free. or realize $20,000 in long-term capital gains that might only cost them $3,000 in taxes. They need to generate $23,000 from their portfolio to net $20,000. Same repair, dramatically different effort and stress. Or try this. You want to help your grandchild with college. You're giving them $15,000. Person A working needs to earn approximately $21,000 gross to give away $15,000 after tax. Because they're earning W-2 income, they pay full freight on every dollar. Person B, retired, strategically takes $15,000 from Roth or realizes it through capital gains at minimal tax cost. They might only need $16,500 from their portfolio to fund that $15,000 gift. The generosity costs the same. The actual burden is completely different. Here's what you see when you study people who end up with powerful tax efficiency in retirement. They built a diversified tax strategy decades earlier. Not diversified investments, diversified tax treatment. They have money in traditional 401k and IRAs because the employer match and some tax deferral made sense, but they also maxed out Roth IRAs every year. They built taxable investment accounts they never touched, letting long-term capital gains compound. In their peak earning years, late 40s, 50s, when they got raises or bonuses, they did Roth conversions. They paid the tax at known rates to get money out of the traditional IRA and into the Roth where it would grow tax-free forever. These weren't exciting decisions. They were boring, methodical, strategic decisions that compounded into massive tax arbitrage decades later. Because here's what they understood. It's not about having the most money in retirement, it's about having the most after-tax spending power. And after-tax spending power comes from structure, not just accumulation. The person with $2 million all in traditional IRAs might have less spending power than the person with $1.7 million split strategically across Roth, taxable, and traditional accounts. Because when they both need $100,000 to live on, one person pays $22,000 in taxes and the other pays $7,000, same lifestyle. $15,000 difference every year. For 30 years of retirement, that's $450,000 in additional spending power, not from earning more or investing better, but from structuring smarter. And here's another thing that shifts. Your negotiating power in your final working years changes completely when you understand tax efficiency. You're 56, your employer offers you a $15,000 raise. Sounds good, right? But you run the math. After federal, state, Social Security, and Medicare taxes, that $15,000 raise becomes maybe $10,200 in additional take-home, $850 a month. Now, you know that in retirement, you'll be able to generate that same $850 in monthly spending power by withdrawing about $11,500 annually from a tax-efficient portfolio, which requires maybe $330,000 in additional invested assets. Suddenly, the raise doesn't look as compelling. You already have $2.1 million saved. Adding $330,000 will happen naturally through compounding in the next few years, even without the raise. So maybe you negotiate for something else instead. More flexibility, more vacation time, the ability to work remotely, things that improve your quality of life now instead of adding marginally to a tax-inefficient income stream. The person who understands tax efficiency makes completely different career choices in their final working decade than the person who's still chasing maximum salary. Now, here's where people sabotage their tax efficiency immediately after retiring. You finally stop working, you've got $1.8 million in traditional IRAs, $400,000 in Roth accounts, $300,000 in taxable investments. You're 65. You need $120,000 a year to live on, and your instinct is to take it all from the traditional IRA because that's the retirement money. So you withdraw $120,000 from the traditional IRA that's all taxable as ordinary income. After federal and state taxes, you're probably paying $25,000 in taxes. What you should be doing, taking $40,000 from the traditional IRA, $40,000 from Roth tax-free, and generating $40,000 from selling appreciated assets in your taxable account, most of which is taxed at favorable capital gains rates. Same $120,000 in spending power, completely different tax bill, probably closer to $9,000 instead of $25,000. You just gave yourself an extra $16,000 to spend every year, not by earning more or investing better, by withdrawing smarter. But most people don't do this. They retired without a tax-efficient withdrawal strategy. They're paying ordinary income tax rates on money they could be taking at lower rates or tax-free. They worked for decades to build wealth. Then they immediately started paying unnecessary taxes because nobody taught them how to extract it efficiently. Let me be concrete about what this costs over a 30-year retirement. You retire at 65 with $2.5 million. You need $130,000 annually. You live to 95. Strategy A, tax ignorant. You withdraw everything from traditional IRAs, paying ordinary income tax rates on all of it. Over 30 years, you pay roughly $650,000 in total taxes. Strategy B, tax strategic. You blend Roth withdrawals, capital gains, and strategic traditional IRA withdrawals to minimize taxes. Over 30 years, you pay roughly $280,000 in total taxes. You just saved $370,000 in taxes. Same lifestyle, same gross withdrawals, completely different structure. That's not money you earned better or invested better. That's money you kept by understanding how the tax code treats different income sources. $370,000. Think about what that represents. That's years of additional financial security, larger gifts to grandchildren, better healthcare, more experiences, a bigger legacy. Or it's money you gave to the government unnecessarily because you didn't structure your withdrawals. Here's what I want you to understand. The difference between $150,000 working and $150,000 retired isn't just about taxes, it's about control. When you're working, you're a price taker. The government sets the rates, takes their cut before you see the money, and you live on what's left. When you're retired with proper structure, you're a price setter. You control which accounts you withdraw from when you realize gains, how much of your income is tax-free versus taxable. You're not at the mercy of the system anymore. You're working within it strategically. And that control, that ability to minimize what you pay while maximizing what you keep compounds into a completely different quality of life. The person who understands this builds their wealth differently from day one. They don't just accumulate, they structure. They don't just save, they tax optimize. And 30 years later, they're living on what feels like twice as much money as their peers who had the same gross income, but never understood the power of tax-efficient retirement income. The tax code is complicated. The financial industry is right about that. But here's what they won't tell you clearly. The difference between tax-ignorant retirement and tax-strategic retirement isn't marginal. It's massive, life-changing. The difference between comfort and constraint, $150,000 in W-2 income and $150,000 in well-structured retirement income are not the same thing. One leaves you with $107,000 to live on, the other leaves you with $139,000. That's a 30% difference in actual spending power from the same gross number. And 20 years from now, when you're retired and living comfortably on what feels like far more than your working income ever did, when you're making financial decisions without calculating the tax hit first, when you realize how much you kept by structuring correctly, you'll look back at the moment you started thinking about tax efficiency. And